Hello and welcome to Ask Assaad. Man, I am waking up. Welcome to the Ask Assaad show. I'm Michael Gaines, host of the podcast NOV today, and glad you are awake with me and joining us for the conversation today as we look to bring insight out here on the Ask Assaad show and bring you insight into the industry, markets, and analysis that matter to the energy industry. So glad you are joining us today. And so we've got our show's namesake here with us today, Assaad Mohanna. And glad to see you, Assaad. Know that we normally jump in and kind of bring in a couple of elements, but I know that we certainly have been paying attention to the news and really the unfortunate events that have come out of Beirut in Lebanon in recent hours and in the last day or so.
Yes, Michael. Thank you for the introduction and great to be here. Last night was a pretty horrible and shocking explosion, devastating thousands of people affected with the blast. So pretty bad, probably a century worst event for a tiny little country that's sitting in the Mediterranean. I was born in Beirut. I was raised in Beirut, and I still have my family there. Some friends, and typically around this time of year would be spending time in Beirut. But clearly, for how the year has been going so far, it hasn't happened. But I'd like to say a word about my hometown before we kick off the show. Lebanon is this little country that's been tangled in the middle of geopolitical conflicts probably throughout its history. But surprisingly to many, its people have consistently managed to keep their chin up, recover from the wounds, and rebuild. It's a big one. This time around, it was a bit greater than the little country can take, and everyone's keeping abreast of the developments going forward. So I want to invite everybody to keep Lebanon in your thoughts and prayers and support wherever you can. The country needs it more than ever today.
Absolutely, and certainly we'll be doing that over the next really the coming days, weeks, and certainly months. So yeah, absolutely, we'll appreciate that, Assaad, and thanks for sharing that. So in today's show, we are going to be bringing in some two guys, brothers, who really have some great insight. And for me personally, when I joined the industry and NOV almost a decade ago, the reports and insight that they were able to provide on really things happening all over the world and how that impacted the oil and gas industry, that impact personally was certainly profound. And so it's quite an honor to be able to have John and Richard Spears here with us today. They are the principals of Spears and Associates, and they have been doing oil field market research around the world since 1965. So they have about 300 corporate clients from major oil companies, oil service companies, financial houses, consultants, governments. I mean, you name it. And some of those have been with them for almost 55 years, which is really a testament to the quality and really insight that they're able to provide. So all the Spears senior partners have oil field operations experience and have the ability to touch every continent with respect to oil and gas insight. So they have a podcast. The Spears and Associates has a podcast called the Drilldown Show that we encourage you to definitely check out if you're looking for really just a great piece of consumable insight and content. And they have over almost 500,000 downloads since the show was launched about 3 years ago. So we're excited to have them. And Assaad, I know that both you and I have had the opportunity to listen to them. So I know you're just as excited as I am to get to have this conversation today.
Oh, absolutely. It's great to have these guys on the show. If this was happening a decade ago, me in coverall somewhere in the empty quarter desert in Saudi Arabia would be pinching myself and them to make sure it's true. It's great to have you on the show.
Good, great. Well, I know that Assaad, you this is the Ask Assaad show, and in this case, Assaad's going to ask. So I know that John and Richard, really have had their nose to the grindstone in terms of things happening. Of course, especially since we've had some of the major disruptions and impacts recently, right, Assaad?
Yes, absolutely. Hey guys, I think you're up now. How you guys doing?
Doing just great. Glad to be here.
Always good. It feels like the Tulsa, Oklahoma is sometimes like the empty quarter. So we have a lot in common.
So today we're talking about something that relates to most of our industry, the sequence and pace of recovery for the upstream oil and gas. We've heard some refer to the recovery process as the healing process. I think it's a good term to apply to the industry because we're going through some sort of healing. We've heard the Q2 results in the last couple of weeks, and we've heard a lot of changes. Besides being the worst quarter, probably on record, a lot of companies are pivoting into new directions of shale versus international, remote op, and digital. What do the Spears brothers think this time around the recovery is going to look like?
Well, it's an excellent question. I hope it's not too early. Rig count here in the U.S. only stopped falling just last Friday. So it might seem to some, Rich, that it's a little early to start thinking about recovery and the pace of recovery. But I think that's what we want to spend our time talking about today. And just as background for the listeners and viewers, our view on a macro basis is that oil prices will probably stay pretty close to where they are today. So with WTI trading somewhere in the 40-ish range, and Brent another $3 or so above that those prices will probably be what we see for the balance of this year and probably all of next year as well. It takes a long time to sort of straighten out the demand supply situation, and that's going to keep prices low. And so in that sense, or because of that, where rig count stands today in the US, Canada, internationally even, we don't see those numbers changing a whole lot, again, over the balance of this year and 2021. After that, the pace of recovery on a macro sense begins to pick up. We think that oil prices will probably begin to grow 20-25% per year as that market tightens. And that's going to pull up field activity as well. So that's the bigger picture. And what we want to talk about today, Rich, I'll let you jump in, is what does this mean for specific sectors of the market? So with that, why don't you take on?
Yeah, so you think about it in three phases, right? You got the phase one, which is the now through the end of the year, early 2021 phase.
Yep.
Phase two, which is the part that comes after that, and then phase three, which is a little further down the road. Phase one is the following products and services. Clear, and it's all U.S. related, because in the U.S. this is where the fastest downturn occurs. This is where the fastest uplift occurs.
Just again, if you haven't been following the numbers, rig count since early March, is down 70% in the U.S. Frac activity has fallen as much as 85 or 90% over that same period of time. So we saw a tremendous drop. Internationally, rig count numbers have come down maybe 25% in aggregate. So a little bit different rate of change, all negative, but sharply down here in the U.S. So I think that sets up the story for the U.S.
So
market.
if we had all of you here in the room with us, you would see a big whiteboard over here. And on the whiteboard, we've got the list of the sequence of those phases. Phase one is led by hydraulic fracturing. It's the thing that fell the furthest, so therefore there's kind of a dead cat bounce going on. But frac activity this year, driven by the completion of wells that have already been drilled and are sitting there waiting. So then all things related to completion in the United States and then Canada. So hydraulic fracturing, cased hole wireline, the provision of plugs that go on, plug and perf jobs, then the process of drilling out those plugs, coiled tubing well servicing. Those are the kind of things that lead the recovery, and it could be Well, I mean, it's going on right now, but it's
Mhm.
mostly because there was that dead cat bounce. It came off the floor.
Sure.
But it could be a 20 to 50% increase off of the lows. I got to put the caveat in here because you saw Q2 earnings come out that were consistently that 70 to 75, sometimes 80% revenues decline. Q3 will probably be worse. And it's worse because of the following. April, which was the first month of Q2, it was falling, but it wasn't terrible, but it was falling.
Yeah.
We're going to replace that April, which had 200, it had several hundred more drilling rigs and several hundred more frac crews.
Right.
We're going to replace that with July, the one we're in or that we just finished.
Sure. Right.
Which had, 290 drilling rigs and,
250.
and 70 frac crews.
Yeah.
So, Q3 is going to be a down quarter. So in terms of earnings, in terms of revenues, Q3 is going to be worse than Q2.
But the sequence of months should
It's
see
already
improvement.
improving.
Yeah. And again, we're cleaning up essentially in this completion business and this frac work that's going to go on. It's basically cleaning up a lot of work in process inventory, as it were, that just got left undone when everybody decided to stop spending and stop activity so quickly back in March and April. So
Assaad, that's phase one.
Previously budgeted for business activity that's gone halfway through, drilled uncompleted inventory that companies are going to jump first on. That's phase one.
That's right.
Yep.
That's right.
So phase two is a little more complicated, and it depends a little bit more on
so phase two is going to be a function of the rate of recovery in oil prices. So again, we see oil prices staying fairly flat next year and then beginning to recover in 22 as that improvement in oil prices takes place.
And by the way, you said 22, but it's just to make super clear, 2022.
Yeah,
that's 18 months from now.
Yeah, that's right.
It's a long time from now.
But as those oil prices begin to recover, that's going to put money in the pockets of operators. We think that then will find its way into drilling activity. So we should begin to see rig count improve domestically, or North America, I should say, first. Probably the recovering that would take place on the international side might even be delayed until 2023. That, the typical pattern is that as oil prices begin to move up, North America kicks off, and then about a year later, the international sector kicks off as well. And so that's kind of the timing of what we would see an improvement for rig activity and all the drilling related markets that you see are land rig contractors, drill bits, you name it. Artificial lift probably gets a boost as well at this point, because now you've got more wells you're drilling and completing. And so the artificial lift market is another one then that's sort of in this second phase where we begin to see improvement take place. So, but again, it's very much oil price driven, and should be linked pretty closely to how fast oil prices recover. That'll tell us a lot about where we think, say, drilling activity should go.
Hey, but Assaad, you want to know where the little bright shining diamond is and all that?
I want to see that. That's what I'm looking for.
He likes silver linings, but he'll take diamonds.
I'll take diamond.
Silver lining, diamond, gold.
I'm easy.
It's the Middle East. The Middle East is, it's not behaving completely contrary to the U.S. market, but it's the place on the planet where it is as much business as normal as possible.
Well, that was the prior cycle. Certainly saw that. We saw very little change in the level of activity going on in the Middle East market, even though oil prices fell from 98 to 30 and then came back. So, and that looks to be much of the same again. There may be some pressure on service vendors with regard to the prices that they're charging for their goods and services, but in terms of the absolute level number of rigs and wells being drilled and so forth, that's going to stay fairly steady. That's right.
Even though Saudi Aramco is a public company now, it still behaves as if it was Saudi Aramco. And so, what you saw in the past, I think, is what you get to see. Now. So that's phase two, Assaad.
So phase two, how do you factor in supply and demand of oil in that respect? Do you guys expect to see more optimized pace of developing fields in whether unconventionals or offshore international fields.
So before you answer, I want to remind folks that just joined us, because I see that there's some additional folks that joined us. We're talking with John and Richard Spears from Spears and Associates. So we've got the true celebrities in the house here. If you haven't read any of the Spears reports, I encourage you to check them out. But we are talking about recovery in the oil and gas industry, what that looks like, and getting some really good insight from the guys themselves. So if you have questions for them, or have wanted to ever ask them a question outside of their favorite ice cream flavor, feel free to put your question in the comment section, and we will get to that a little bit later in our show. So sorry to interrupt. I know that train of thought was speeding ahead, and maybe you got to re-tee up your question, Assaad, because I know I have the memory of a goldfish. So go ahead and try that one.
Appreciate that. You gave these guys a bit of time to think about my question, which is
sure.
Which is a little cheating, but it's okay.
Well, you're asking about, what kinds of fields, or how operators would go about, developing fields. I mean, that's a very interesting question. I think there unfortunately won't be nearly the kind of push to develop shale like we saw here in North America that really drove the cycle of the last 17, 18, 19 timeframe. I think a lot of operators are, realize that that's a high cost business. There's clearly a lot of investor push on companies to go about things on a profitable basis and not chase volume growth. So I think where the balance of opportunity is going to lie is going to probably be overseas. In the international market, offshore certainly will get its share of activity, and so I think that's where we'll begin to see operators selectively go to work. That's wrapped up in a lot of another interesting discussion that's all about, so many of the bigger oil companies are adopting climate change initiatives that really have them kind of backing away from the upstream sector of the business over the next 20 years or so. And so that's going to begin to affect the decisions
over the next 20 months.
Maybe so. Yeah.
It's like right now
about the exploration and development that they do. So
right. Okay.
We were talking about the second sector. I want to, make sure we sort of talk about who's going to lag this recovery process. And I know you've got some thoughts about all of that, right?
The thing that always lags, the last thing to turn up, is the capital spending of the service companies themselves.
I was going to get to that. Yeah. So sorry. Phase one is going to get to the cheapest barrel you can get, something you've already invested in.
Yep.
You've used up your DUC inventory, move towards drilling, use that cash flow to drill new wells, produce some more. 2023 is phase three.
That's right.
Yeah.
Yep.
So the very last thing that gets built is another pump truck, because you had 25 million horsepower just in North America, and there might be 4 million of it working right now.
Right.
And so phase three has to sit there quietly with its hands folded, waiting until the last pump truck around has gone back to work.
Yeah, the capital spend by oil service companies for the drilling rigs and pump trucks and wireline logging units,
coil tubing units, just
coil tubing,
everything with the wheels on it.
Everything that they use, what that depends upon is the profitability of those company and the utilization of those assets. And only when those numbers both get high enough do we see new money coming back into the capital spend business for these, or the spend business for these capital items.
I can't think of a single company that makes both drilling rigs and pump trucks. Can you?
No. So an interesting question as part of that is does new technology in that sector, would that ever drive capital investment?
Faster drilling rigs, faster pump trucks.
There you go. Right. It's like the Soviets. They made the world's, biggest microcomputers. Right. So that's the notion is there something there that might drive spend? I don't see that happening now. And I don't see the nature of the fields we're exploring and developing as driving that yet. So I think they're just going to have to wait their turn until utilization gets to be high enough. Now, what's key to that utilization figure is something you've talked about, which is how fast do they begin to tear up and destroy and retire all these old units that aren't working?
Right? Yeah, I mean, let's go back to phase 2, but it still matters. Let's take drill bits. Here in the United States, it's a rental market for drill bits. And so you built enough drill bits out there for the rental fleet to support, 1,000 rigs or 1,500 rigs running. Well, now you have 300 rigs running.
Sure.
So I've got this fleet of rental drill bits out there that you just have to wait as you work through, chew through the diamonds, chew through the drill bits until you get the fleet down to whatever the new size is.
Right.
Same with drilling rigs. Actually, but a drilling rig lasts a long time.
Sure, yeah.
It lasts for years and years and years. So the only reason why a drilling rig gets built is if there's something fundamental about that drilling rig that has changed because the drilling parameters have changed.
Right.
When we went from vertical holes to horizontal, that was a change. When we went from conventional directional drilling to rotary steerable drilling, more horsepower, more derrick load, all those things.
Yeah.
What's that next thing?
Right.
And whatever the next thing is, that drives then investment in the entire capital structure of the or capital equipment structure.
And when we looked at kind of the pace of recovery for capital equipment, clearly for NOV, there's certainly a massive factor of utilizing and cannibalizing that existing inventory that's been bought out there during the last 15 or 20 years. So I think we've gone through a lot of that in the last 5 years because there has been capital spending constraint. But you're right. There's certainly going to be that behavior of don't spend until you absolutely have to. Don't change that string of pipe unless you absolutely have to. But with what we're seeing, I think with technology, and we'll talk a little bit more about that, was when you come up with things like digitalizing or remote capabilities for some of these products, then some of these operators are pushing contractors or working with contractors to adopt faster.
Well, that's absolutely right. I mean, the last 2 or 3 years has seen a real push by operators and service firms alike in terms of this digitization, automation, the use of big data. There's a lot of different terms that people throw around, but that's clearly driving part of that important part of the technology adoption going on out there. And I don't see that part of R&D changing very much. The industry, the oil service sector last year spent on the order of $3.4 billion for research and development. Half of that was spent by the big three companies. And what we find is that R&D dollars are oil price inelastic. The oil price goes up and down. Research and development spending has stayed pretty steady over time because companies needed to
job security for the scientists.
Well, yes, because they needed to maintain that technology edge and develop new products and so forth. But this year, we're already beginning to see. I wouldn't be surprised if this year we see some of that R&D spending factor back.
Yeah,
15%, 20%, maybe even as much. So then you say, what's get lots, what gets saved? I think this digitization piece is one of those that probably is maintained as best as companies are possible to do that. So, and then that should, like you say, roll into new products, new services that people pick up on. So, now one other thing. Well, go ahead, Rich.
Well, no, I know that Assaad is thinking right now. All right, so there's technology. What about consolidation? Am I reading your mind, Assaad? Am I reading
it? What are lotto ticket numbers again? Do you have those?
Yeah.
I think he'd like to know.
Yeah.
Oh, Lord.
So consolidation. What do you got? Yeah.
There's multiple things. There's multiple ways to think about consolidation. One is the classic when you think about, merger and acquisition stuff. Yeah. Big company buys little company, 2 equals merge. Somebody gets bought out of bankruptcy. There's that M&A sort of stuff. On the oil company side, there's lots of it going on.
Sure.
On the service company side, I don't think so.
Not very much. The pace has fallen way off because there's such a big spread between the bid and the ask price for those assets right now. So I don't think M&A is going to, for oil service firms, is going to pick up until we see markets broadly begin to grow again. So that could be 2 years off quite easily. So,
but there are 2 aspects of consolidation that are already underway.
Yep.
One of the consolidation things is actually, what do we call it? The destruction or the removal of assets.
That's right.
If
right.
you see, my brother and I do make direct investments in oilfield service companies. They're generally private, but our well servicing companies are destroying old well servicing rigs.
Yeah.
If you haven't used it for 10 years, if you haven't used it for 20 years, chop it up and throw it away. Get that out of get it out of the patch.
Sure.
Don't sell it, just get rid of it. And so there's the absolute destruction of these units. Same with pump trucks. Our research suggests that if there's a pump truck out there that's older than 10 years old,
For frac truck now.
which is pretty old for a frac truck, even though
gosh.
there's 20-year-old and 30-year-old frac trucks out there, that's a candidate for destruction, not for sale, but for destruction.
It's one way to take assets out of the.
And I think we've seen some of that with retiring rigs, big drill ships that are 8 and 10 years old. Some of the big offshore contractors, and I like the way of thinking you're suggesting around consolidation. Consolidation is not limited to number of organizations or players that are contributing to unconventionals or international markets. But also consolidating that entire fleet, that entire horsepower capability that's out there into more adequate capability that can support the demand that's out there.
Absolutely. I mean, if utilization is the key number, then the denominator, the fleet size, is the key there. So how many organizations own those units is almost immaterial. The other part that I think we'll see more of, that
This is our favorite one.
on the consolidation side, is is on the manufacturing sector, really. And I think there we're going to begin to see companies outsource the manufacture of some of their products and essentially turn it over to a third party who may be making that same kind of product for several different vendors in the marketplace. He's essentially private labeling whatever it is what he's making. But I think that's another way where service firms or manufacturing guys anyway can take some assets off the books, basically.
Well, and think about it, dishwashers.
Yeah.
There's like 3 manufacturers of dishwashers, but they all label them different. There's 2 manufacturers of computers, and yet how many different brands of computers can be? So in the oil field, it hasn't typically been done, but we are participating in it, that behind the scenes, the manufacturing in a single plant, but for 2 or 3 or 4 or 5 customer-facing companies. That's the consolidation that I'm the most excited about, because that actually works.
Oh, sure. Yeah. I mean, so it'll be, it's going to kind of some management issues, challenges with that particular process. But that's the other way I think we're going to begin to see some capacity leave the industry. And so it's a slow motion process, but that's another piece to the consolidation puzzle, which will help.
And so it is really, really interesting to John and Richard, your points on that. There is, pick your precious metal or stone of choice. There's a diamond out there. The kind of the glistening horizon. Assaad likes to say the silver lining, and I know Assaad that you've got visibility obviously outside the organization, but also inside. And so I think you've been able to see kind of firsthand some of the things that I guess that we're doing within NOV to kind of position for kind of those better days ahead, I think, as Clay mentioned in the recent earnings call.
Yeah, I was going to refer to that too. I think we heard from our CEO Clay Williams and Jose Bayardo, our CFO, on the last earnings call on what NOV is doing to remain upturn ready. And it's not easy these days to remain upturn ready or just adapt to the current environment to survive through. And I think that's for many is the biggest challenge. Protecting the balance sheet is clearly one, but I think there's lots of other stuff that NOV is doing to remain in that position where we're able to support our customers when they're going back into completing those ducts in phase 1, like John and Richard mentioned, but also when drilling and production all come to line. Some things we're doing, and we mentioned a little bit remote ops and some of the communication enablement to troubleshoot on drilling rigs, whether onshore or offshore, without having to send people on location. The downhole capabilities that our Wellbore Technologies group is developing to also contribute to less NPT, less requirement for personnel on location. The data analytics, and Jose alluded to something coming up down the pipeline, to maximize efficiency, enable operators to make more sound decision real time that'll ultimately impact productivity and cost per barrel. Some of the things, I mean, we touched on phase 3 and more efficient rigs and completion and production. That's probably further down in the lineup, but definitely doing. We have our R&D facility up in Navasota, our RDTC, where we're also showcasing and testing our capabilities. Let alone the fact that we're also making some of the coolest technology when it comes to offshore wind tower installation vessels, geothermal capabilities, solar technology, and some others. So a lot of NNOV that can be brought to the table once things start turning to the right, once the phones start ringing again, like Clay said, and to remain kind of ready for it.
Well, I know that neither of us, Assaad nor I, are in the business of trying to take all of our guests' time and questions. So we've got some Q&A that we're going to open up, and I think we've got some questions on the docket. So we'll bring in Shelby Dumaine, who will help give us some of those questions that we have out there. Hey, Shelby. Oh, I think we got you muted.
How about, are we there?
There you go. All
right. Never know.
Read lips, but I decided maybe not today.
there are a lot of buttons, got to make sure they're all on the same page. So yeah, it's been a great interview so far, and we've gotten some good questions. This first one, I'll warn you guys ahead of time. It is a two-parter question, so I'm gonna, I'm gonna do my best to read it all out, and I can definitely reiterate some of the second question if need be. So do you believe that shale is going to lose all of the efficiency gains of high volume and close proximity that we had in this long boom climb in the market? And then the kind of second question there is, will the small companies that facilitated the efficiency and agile muscle and behavior be gone?
Ooh.
Yeah.
I'll take the second one. I want to take the second one.
I think scale has proven to be a key to cost-effective development of the shale market. So those operators who have a large, number of uncompleted, prospects, and can run way down the learning curve, so that they can get those wells drilled and completed at the lowest cost, are the ones that are going to be the ones who are working. Don't see the guy who drills 3 or 4 or 5, a couple of pads of shale wells a year as being the kind of guy who does that. And so I think scale will remain to be key. Both scale for how many holes am I punching, plus the size of the job that gets done.
You and I both went to college in industrial engineering.
That's right.
And it is all about the study of efficiency, efficient operations.
In manufacturing. Yep.
And efficient operations in manufacturing. And the oil field adopted all this too.
Sure.
Was to have this standard, or let's call it cookie cutter, approach to getting a whole bunch of things done in as rapid an order as possible, as equally as possible.
Sure.
So lean manufacturing was
Six Sigma, the whole 9 yards, yeah.
But and the oil field did a really good job of that. Yeah. Boy, we adopted that all the way from site preparation to drilling the hole in the ground, to fracking the well, to flowing it back. I mean, we got that thing down.
Yeah.
But it was on the backs of the 2,000 service companies that sprung up that all had essentially the same type of equipment to go do this work. So what I wonder is, as Shelby's question was, or she transmitted this question, what happens to these small, agile companies that made that happen? you know what? If you're not differentiatable, or if you yourself don't have scale, or worse off, you have a terrible balance sheet.
Yep.
Bend over.
Yeah, it's going to be tough, isn't it?
Kiss your rear end goodbye.
Well, and it's going to be tough because as the industry begins to scale, ramp back up, what happens? You need more working capital, right? Because you've got to hire people,
money. Hire,
train, refurbish your equipment, restock, whatever. Where's that money coming from?
Bank of Texas.
That's going to be really tough.
They're going to say no.
It's going to be really tough for a lot of smaller firms who just have lost the access to some of the financing that they had in the past.
So once again, in the upturn, you see it all the time.
Yeah.
But in the first year or so of an upturn, the company that does the best is Halliburton and its peers, because they have the balance sheet, they have the banking relationships, they've got the global reach, they've got trucks everywhere that they can redeploy.
And they can fund the ramp up. Yeah.
They can fund the ramp up.
Yeah.
And so if you're talking about 2021, 2022, those are the type of companies that succeed first.
Yeah.
And after that, the banks sort of get a little more comfortable. Private equity comes back in.
Yep.
Then the small companies are there. Is that a long answer to a short question?
I think we answered question, parts 3, 4, and 5.
We did.
That was a bonus answer.
I think on the capital behavior, I think maybe we didn't touch much on it, but I think it's a critical one. That's one area of transformation where and you guys are closer than most on that too. It's just the discipline there is changing, and easy money is not so easy anymore. And you gotta really have that differentiator, Richard, like you mentioned, to convince whoever your lender is to make that investment.
Absolutely. I mean, if you don't have a lender, you think the other sources of financing might be either customers. I don't think oil companies are going to help you.
No.
But maybe suppliers. So somebody who's making that X that you need to buy might be. So there's a little bit of supplier financing that might come through, but it's going to be tough. It's going to be really tough for small firms.
They get you a little part of the first leg up. But but again, in the oil field, the suppliers to the industry are just as broke.
Many, a lot,
as everybody else.
Instances,
the thing that's going on in 2020 right now is that those people who had provided debt to the industry are in the process of converting that debt to ownership of all these companies.
Right.
Oilfield service companies were never designed to be owned by the debt providers, but that's what happens in the form of Chapter 11 or negotiated recapitalization. That's going on right now. That is a big elephant that's being squeezed through the anaconda right now.
Because those firms, those new owners, don't want to stay owners forever. I would presume,
and they don't want to invest in the companies.
Right. Yeah,
pay me back. And get me out of this thing as soon as you possibly can.
So stay tuned. There'll be activity down the road.
More activity in the jungle of the oil field. Sounds good.
Yeah, was that analogy a little awkward? I thought
we're open here in the Ask Assaad show, so we'll take many perspectives.
Yeah, thanks.
Absolutely. Well, I thought I'd start y'all off with the longer, more difficult question. So now the second question, by comparison, should be super easy. So Kelly Bird on LinkedIn was wondering what your insights are on the Deepwater and Gulf of Mexico markets.
We're all for it.
Those are very interesting questions, because those types of fields tend to have pretty low finding and development costs. I mean, we're talking sub $10, right, in terms of the direct cost to develop a field. Now, the problem has been that the time to get that developed has often stretched into the better part of a decade, right? And investors in the oil field companies just don't want to see that happen anymore. So there's a real push to, can you shorten that cycle time? Maybe go someplace else that you don't have to spend money for 6 years before you start making money. So that's going to be the challenge there. The other issue for offshore in general, international in particular, is that typically the host government captures about 60 to 70% of the revenues from the sale of oil of those fields. And we haven't, in ages past, when oil prices fell, a lot of times we saw those host governments restructure the financial incentives, and that's sort of helped keep activity going in terms of exploration and development. We haven't seen any moves to that degree this time around. So the host governments are tending to stick tight with regard to how much money they're going to claim off that field, and that's a problem. So that's going to be another thing that oil companies are going to have to be very selective. I think that they'll end up being very selective about where they spend their E&P dollar.
And just to
Yeah.
put an exclamation point on this,
Yep.
it's our view that if a project being an oil field development, an
Mhm.
oil development project,
Right.
if it has a time horizon of greater than 10 years,
Yep.
forget about it. And ideally, it's in the single digit years sort of time horizon, because
Mhm.
the entire European financial community has this view that that oil is in decline,
Right.
that
Peak
demand
demand.
for oil
Yep.
is
Peak demand in 2030. Right.
because we're all going to be driving solar powered cars.
Stranded assets after that point.
And so if you're going to invest in an oil field
Mhm.
where you explore, develop, and then produce, and that production comes in year 12,
Yeah.
not going to make it.
Or the
It's not
field
gonna-
lasts for 20 years, right? That's
like,
the other
why
issue.
would I invest in
Right,
that?
yeah. It's a tough sell. It's a tougher sell than
Yeah.
it has been before. So all these things go into the mix when it comes to deciding what kind of fields to develop. But frankly, most of there's been a lot of very excellent finds being made. It's just tough to get to the decision from a commercial standpoint at this stage.
I would maybe add to that a couple of things on maybe deep water, or really rather reserve replacement, where we've seen a great decline in how much proven reserves oil companies have been finding over the years compared to how much we're producing or plan on producing in the future. And I know, John, you recently wrote a little bit about that recently, but I think that may be a driver for exploratory activity, although we haven't seen a great uptake. That could be an area of growth for deep water, especially with a well in Gulf of Mexico could produce 20,000, maybe 30,000 barrels a day compared to the 1,000 barrels we see from a shale well. So very promising. But to your point, if it's going to take 6 or 10 years to develop, that's just not going to be on the books. The more activity that we could be seeing is perhaps on the satellite fields, the subsea tiebacks. You could develop some of those and connect them to existing production facilities, because at the end of the day, that's really what's costing most of the budget in the development and timeline, really. So perhaps maybe those are bright areas to dwell on for those fields.
Absolutely. I completely agree with what you said. Yeah.
And when you do that, our outlook for the subsea tree market is actually pretty good. It falls the least right now,
Mhm.
and it has the longest term, uptick.
Right.
But and if you do that, then the supply vessel business does okay.
Yeah.
The helicopter business kind of does okay too.
Yeah.
So, those ancillary services.
So you get, but a lot of
are-
that subsea tree driven is driven by satellite field development. Like
Exactly.
I was saying. Yeah.
So-
Absolutely. Right.
Well, this has been really, really insightful. I know that if we certainly had the time, I'd love to continue our conversation. But unfortunately, Assaad has given me strict instructions that he can't sleep at the office overnight. So I've said okay reluctantly, but I've said okay. So, but no, so we've for those that tuned in, we've been talking to John and Richard Spears from Spears and Associates and getting their insight on the recovery in the oil and gas market, and also insight into some of the other phases of the recovery coming up. So, John, Richard, thank you very much for taking the time to join us today.
Our pleasure.
Thanks, guys.
And thank you for joining us. We always appreciate your feedback, thoughts, comments. If you have any ideas for future conversations, future guests, or any ideas in that space, we encourage you to send us an email, easy email address. It's askassad@nov.com, and we'd be glad to get those ideas. But again, a special thanks to John and Richard Spears. Certainly encourage you, if you're looking for some really great, detailed, and thoroughly compiled research, Spears and Associates, SpearsResearch.com is the place that you can find more information from John, Richard, and the rest of their team. That's spearsresearch.com. So thank you for joining us today. Thanks for watching and for listening, and we will talk to you next time.